Hello, everyone, and welcome to our next week's installment of our weekly presentations. This week, as you may have seen already, we will be focusing on a couple of different areas. One, more importantly, we will be focusing on the concept of globalization and international investing. We've begun looking at international investing and international investment decisions slightly already. But we'll look at this and expand on a couple of key factors as we make our way through this week and more importantly through this week's presentation. So I hope this helps to clear up some issues. The first thing we need to discuss first is that there is a global market for equities. In recent years past, this has had exponential growth that has never before been seen in the market, especially the creation of a global market. It's important to keep in mind that the U.S. stock exchanges make up approximately 40% of all markets in the world. Even though this may seem like a large number, it's important to keep in mind that when investing and making global investment decisions, that although this is a large number, it is still less than half. So it's worth keeping in mind that there is an additional 60% that must be accounted for. And this is due in large part due to emerging market development. And as markets continue to emerge and evolve, this number of 40% will gradually decrease, which means there is an increased importance to take into account the global market. And this is also due in part to market capitalization, as well as keeping in mind the gross domestic product, not only of our own country, but also of other countries as well. One thing to keep in mind is that there are additional risk factors involved once we engage in international investing. Here's a brief formula, which we'll touch on more on these as we go through the week, but to scratch the surface quite a bit, we have here the formula for returns within a foreign exchange, where R sub DOM is going to be the return on the foreign investment in the domestic currency, where the R4, R sub 4, is going to be the return on foreign investment in the foreign currency. And then we have the exchange rate, which is factored into these as well, which this will allow you to determine and take into account the risk factors involved in investing internationally so that you can determine what your return on the investment actually is in a quantitative form. Some of the other risk factors in international investing is the dollar depreciation relative to the pound. You can also include this in any other currency denotation that you would like. So it could be the dollar depreciation to the peso, to the yen, whichever you would prefer to denominate it into. If you invest, for example, in a British security and earn a 10% rate of return, you would have to find the return in the US dollars given. So the original exchange rate would be $2 and the end exchange rate would be $2.10. What you would do is you would plug this into your formula, as we see here, where we have 1 plus the rate, which we have what we earned 10%. So that's where we get our 10% from. We plug this into our fraction as well when we have the $2 divided by the $2.10 divided by the $2. And we work this through and we see that we have an exchange rate of 15.5% or a final rate of 15.5% because of the fluctuation in the exchange rate. Now, this is a positive example in that the exchange rate was of benefit to us. The important thing to keep in mind is that it can also, the pendulum swings both ways, as they say. So if the exchange rate were to go down, this could erode or completely eradicate any potential returns that we may see. So important to keep in mind as we work our way through these various components involved in international investing. Other things that we have to keep in mind are passive investments, do not necessarily occur in all countries, that would have lowered risk during the recent crisis. So what we can glean from this is that when we have domestic economic crises, we can now look, since there is this creation of a global market, to outside international markets in order to reduce or transfer some of the risk. This is through the practice known as hedging, and you can hedge currencies. However, this has little effect in that the U.S. stock market crash appears to be systemic, and that means it's going to impact other countries. Since we do have 40% of the world's market, whenever the U.S. market does have a significant swing, whether it's up or down, the ripple effect is noted in many other foreign markets. Correlations, important to keep in mind, are increasing due to globalization, making the process of hedging and diversification outside of the domestic market more challenging. We still expect modest international diversification benefits in normal markets, but it is still important to keep in mind that as we approach and continue to approach more of a globalization and a global economy, that these abilities will be diminished in some degree. So I hope that is helpful for everyone. I look forward to our continued work together in class, and I hope you are finding these videos to be beneficial. Thank you all.